Everybody, this is Jim at SP500chart.com. It's Sunday afternoon about 1:30. We're going to take a look at what happened last week in the S&P 500 in our free weekly review. And it's free because, you know, we look back in retrospect. We look at the trend lines that we've drawn through the week, see how things worked out, see if this method of looking at markets makes any sense. And in retrospect, you can figure out if it does or not. If you really want to get a little bit more interesting with it, though, I would suggest you go to SP500chart.com and sign up so you get the daily stuff. That way it isn't so much retrospect, but it's more like, well, this is sort of what we're thinking is going to happen. I will remind you that the website and this video are for educational purposes only, and nothing stated at the site or in this video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I am not a licensed financial professional. I'm just a guy who draws lines on charts. So let's take a look. Starting out here on a 30-minute chart, I will remind you, we've talked about a couple of channels that are visible on this chart. The two that are important right now are the larger red channel that's been working for more than 22 months. This is our resistance line, which is significantly higher than where we are right now. And here's our support line. We are really actually closer to the support line than we are the line of resistance. So what that means is if we stay in this channel, then this market has room, technically, according to the channels, to probably make a go at 2,700 before we would expect significant resistance. Notice I said before we would expect technical resistance. We might get resistance somewhere at an unknown spot because the S&P is in uncharted waters right now. We set an all-time closing high on Friday. All-time closing high for the day, month, week, you name it. So decade, century, going all the way back, the S&P has never closed higher than 2587. And here we are. Now, there's also a smaller channel that is between this line of support and this line of resistance. And I will show you something, and those who do the daily thing, those who see this every day, will attest to this. That this line was in place before Thursday's trading. This line I did not move this line at all. It was updated on the 29th, which was over the weekend, last weekend, but where we tagged that line right there is exactly on that line. And during the week, particularly Wednesday through Friday and Thursday, we'd identified the potential of, depending on which set of, how you want to look at it, it's open to interpretation. All of this is open to interpretation, but either this is a small inverted head and shoulders pattern right here, with this being the neckline, or right here, I guess we could move that to parallel, with that being the neckline. And I'd sort of mentioned on Thursday, those who get the daily video, I said, you know, it would not surprise me if, because we'd already started to kind of break over that line, I said it would not surprise me if in the day or so ahead we see a little rally that peters out and then comes back to backtest that line before it then starts to move up for our target, minimum target, I remind you. This is not the maximum target. This is the minimum expected target up here at 25.94. And where did we get that? I think we get it on, do we get it all on a, no we don't, sorry, got to go to the 1 hour chart. We get it from this inverted head and shoulders pattern right here. Just as a reminder, what is a head and shoulders pattern, or in this case, what is an inverted head and shoulders pattern? It is a very common pattern in financial markets that consists of, if it's inverted, a dip, a larger dip, a smaller dip, a clearly defined trend line that defines all three of those dips, and then breaking out over that line, then in about three cases out of four or 8 out of 10 will result in the stock chart eventually reaching a target that is measured. Now, here, listen up. You measure the depth of the head of the pattern, and then you look at where it broke out, and you put that measuring stick right there, and that's where we got that 24.94. We've been doing this for at least 7 years in the S&P, seeing one inverted head and shoulders pattern after another. I mean, they have been lined up like I'm from Atlanta. They have been lined up on this chart like flights coming in from the east to land at Atlanta Hartsfield Airport. I mean, it's just been one after another. Obviously, we're not seeing one every minute or every 30 seconds like the planes land in Atlanta, but you know what I'm saying. We've seen a lot of them, and they've been very regular and very predictable. So this week, I'm going to just remind you, this week was one in which we saw a couple things. First off, coming into the week, we had drawn a little trend line right here, short term, with the idea that because we're sort of messing around in this blue channel here, that if we get over this line right here, we should start to see some firming up, and we should, at that point, be making our trek up to our 25.94 target. And that's pretty much what happened this week. Starting on the 30th, actually on the 27th, we broke above that line, which sort of was the precursor this week for what is to take place. And so far, that has been exactly what it looks like. The little surprise, there was a little surprise, and that was the weakness on Thursday when we came down to tag this line again. I thought that there was a good chance that we could see some gap support right there from the gap between Tuesday and Wednesday. Instead, we actually came down and tested that line of support one more time. Now, if we're looking at this small inverted head and shoulders pattern right here, I think even though this is a very small pattern, and because it's such a small pattern, we cannot apply that 1% rule for a breakout. And what is the 1% rule? Well, that says nothing is technically significant as it relates to a trend line unless it is broken by at least 1%. And that applies to something like the S&P or a large cap stock that has a lot of that is very broadly traded. You cannot apply that 1% rule to a penny stock. You can't do that. As a matter of fact, if you're trading a $2 or $3 stock, I would almost say you've got to start looking at 10 or 15% before you can say anything is really worth technical significance. Because obviously a $3 stock, a 1% move is 3 cents. That's nothing. But when we're talking about something that is as, well, what's a good way to put it? Something that is as large and massive as the S&P 500 index, that 1% makes a difference. So, all that to say, even though this is a little inverted head and shoulders pattern, and I think we can probably trust it as being a very small inverted head and shoulders pattern, for practical purposes, it doesn't do us a whole bunch of good. And the reason is because by the time we get our 1% above that line, we are already above the minimum target. So the minimum target on this, having broken out at 25.83, the minimum target is right at about 25.97. Well, you get to 25.97 and you go, wait a minute, that's only about 0.6%. So you can't use the 1% breakout rule because that's greater than the minimum target. Does that mean we ignore this? No. I think you look at it and you say this is revealing something about what's going on in the markets. But it simply is revealing something on a very small scale as opposed to something that's a more tradable pattern. To give you for instance, back 2 days, back when we were talking about this inverted head and shoulders pattern in 2015 and 2016, we knew that to be a very, very tradable pattern, because getting above this neckline right here, which was at the time at about 2110, with a target of 2468 going by memory. Was that what it was? 24. I hate to say it. I don't remember what it was, but the idea being, it was like we're talking about an 8 or 9% improvement once you break out here, as opposed to 0.6%. So going forward into this week, it's really pretty simple. We got these little tiny inverted head and shoulders patterns. Maybe those are a hint, but I'm still a little bit focused on these channels. I would say, for me personally, I'm keeping an eye on the channel action. If we start breaking down, if we start crashing through support, then that should be a shot across the bow for bulls, to where we would think, well, if we break this blue line, then you have to say, well, are we going to come down? Are we going to test this line? Well, then what happened to the idea that when you're in a channel, you hit the top, then you hit the bottom, then you hit the top, then you hit the bottom? If we fail to hit the top and then we come back down to the bottom, then you have to wonder, well, is this large 22-month channel, is it about to break? So obviously this would be the first shot across the bow. A break of this would be I would say a hit, but not catastrophic necessarily. We don't really get into catastrophic signs until we break through this blue channel that we're looking at right here, that has effectively been, along with this line of resistance, this line of support has been working for almost, been working for 8 years. So there you go. And you might ask yourself, well, why does it not touch the low back here in 2009? Well, we sort of got precedent for that. When we had this run from late 2002 until 2007, you'll see that we were in a parallel channel that did not take these lows into account. And there's a reason for that I've talked about in the past. I won't bore you with it this week. But for right now, my parting words: watch the channels. If they start to break, then we know we need to start paying very close attention and to be on alert that this bull market, though it could last for a lot longer, if we start to see support lines break, then I would expect weakness that is commensurate with the scale of those lines. In other words, break short-term support, expect a short-term correction. Break intermediate support, expect an intermediate term correction. Break long-term support, expect a longer-term correction. So there you have it, guys. I want to thank you for taking time out of your weekend to watch this. And as always, thank you for your very kind support.